Hi everyone, it's Chad about another video, and today I'm going to be talking about American Express stock, a fantastic business, technically a bank, most famous for credit cards of course, actually trading at a relatively reasonable valuation right now. It's lost 13% of its market cap this year, or in the past year. It's trading at around 15.5 times earnings, $110 billion market cap, being an absolutely fantastic performer over the long term, and year to date it's around flat, pays a 1.6% dividend. It's one of Warren Buffett's largest holdings for a reason. It's been a spectacular compounder over the long term and generally has a really high moat in this business. As of the most recent 13F filing, American Express is Buffett's fifth largest position, and it's been this way for a very long time. The average buy price is way off here. He hasn't really added to this position since the 90s because it is huge. $22 billion in value. It's around 20% of American Express's market cap. I think his original bite he bought 5% in the 70s for around $20 million. Obviously, truly incredible returns since then. He's been a long time fan of this business and is more than happy to pick up dividends and have it see his share increase by share buybacks. Currently occupies 7.5% of his portfolio and is one of the better returns on the list. You can see, for example, like Kraft Heinz has been doing really poorly. Coca-Cola doesn't really go anywhere. American Express over the last 5 years has been a very strong performer. As you can see, this is only since 2008, so over the last 15 years. But in 2008, it was as low as around $25, and the current stock price over $150. Absolutely fantastic returns, just consistent, steady growth regardless of market conditions, effectively with the growth of payments worldwide, and then some, a little premium on top of that. Dividend payout has also increased at an absolutely excellent rate. This is a consistent compounder of dividends. Australian 12-month dividend yield is very rarely above 2%. Only in 2008, when the stock had a big drop, did it even get above 3%, where it was just got over 5 in 2008, 2009. Right now it's currently a respectable 1.61 around the S&P 500 dividend yield, if a bit less, but continues to compound year over year and is reliably paid out. The most recent results for this business got a kind of mixed response from the market, and it was actually down a couple of percent on the day. Revenues net of interest expense were up 22%, FX adjusted 23%. The problem, which is absolutely excellent for a company this size and scale, far above what Visa and Mastercard were doing, its key competitors really. The problem, net income was down 13% year over year because of increased expenses, diluted earnings per share down 12% because they had a couple of buybacks basically. They reduced the share count by about 14 million. That was a 2% decrease. Net income was down because expenses were up. In a higher interest rate environment, it's kind of hard to get hold of new credit card customers, and even though they had a strong performance in terms of new cards added, that was because they had to increase the amount they were spending on member rewards. Business development costs were up around 34%, card member rewards were up around 21%. This is always going to be a very large expense to this business. It's kind of what American Express cards are all about. So seeing that number at $3.7 billion, not really any concern for me, but the 21% increase is a little bit of a concern. 57% increase in card member services, 28% in variable customer engagement expenses, which is essentially marketing, 10% in marketing increase, overall operating expenses increase of 17% and total expenses up 22%. This is not what we like to see. 43% of revenue for Q1 2023. It's not the end of the world by any means, but it is dramatically affecting net income, if only down 12%. Over the long term, those new customer adds will be very strong for the business. However, it's not really what we want to see, is revenue increasing at a rapid rate and net income not really falling. One long-held bear argument with American Express is that it's mainly for wealthy, middle-class Americans, or it's not caught on anywhere near as much around the rest of the world as it has in America, and that millennials and Gen Z are just not going to have the same uptake, and the prestige and the moat of American Express does not matter that much to them. That could not be further from the case right now. Gen X currently occupies around 37% of the total consumer services bill business for this business. Millennials and Gen Z now 30%, baby boomers 32%. Now generally Gen X and baby boomers are just going to have more money, and so they are going to be a larger percentage of consumer services and build business. And millennials and Gen Z tend to spend more on rent, for example. 37% and 32% for Gen X and baby boomers respectively, but 30% and growing, more than double as fast as the next closest. Really impressive. 16% year over year growth for build business generally, but for millennials and Gen Z that was 28%, far higher than the other two. Really impressed with this, and impressed by how the millennials and Gen Z percentage of this business just keeps on rising. Total net worth volume growth was equally impressive. Of course, inflation is going to be playing a part here by literally just more dollars being spent for the same item. However, people are trying to keep more money aside. People's mortgages cost the mortgage of interest rates, so they're equally balanced out. I see this as just a relatively strong quarter. Total net worth volumes increased much faster over the last few quarters, don't get me wrong, but this is a business trading at less than the market right now in terms of price to earnings, around 15 times earnings. 16% net worth volume growth is very, very impressive, even if it isn't as impressive as previous quarters. Also impressive is the continued net card fee growth, 23% for this quarter. That is a decent acceleration over the last 2 years. You can see 11% in Q4 2021, up to 16, 19, and now we've seen the peak in Q4 2022. Of course, that's the holiday quarter that tends to be very high. They're nice numbers as far as I'm concerned. 23% is a good net card fees growth. And in terms of new cards added, they had 3.4 million cards added. Very impressive. One of the highest quarters they've had in the last 5 years or so. The highest they've had in the last 2 year period. Very, very impressive. So overall, very impressive revenue growth. Not the best net income growth by any means, but I think that can kind of be forgiven given the interest rate environment. Strong net new card adds and strong growth of net card fees. It's a long-term compounder and we're getting it for 15 times earnings. That is too cheap in my opinion. It's currently trading around 7 times trailing cash flow compared to its 5-year average of just under 12. Its 5-year average price to earnings is around 19.5. It's trading for around 16. So its 5-year average is currently what the S&P 500 is now, which is inflated to what it normally is. Right now it's trading at just 16. That is very cheap in my opinion. It's also trading at a discount to book value, a discount to its price to forward earnings compared to its 5-year averages, and a significant discount to its PEG ratio compared to 5-year averages. For me, this is one of the cheapest opportunities to buy Amex there has been in a very long time. For me, this business is too cheap. Buffett loves this business because it's conservatively ran. It's a long-term compounder of both its dividend and its stock price at excellent rates. Never really does it trade for super high valuations, normally in that 15 to 20 range, sometimes above 20, most of the time below, but normally at premiums to the market, and right now it's trading at a significant discount to the S&P 500. I think this is not an absolute bargain by any means. I much prefer this in the P ratio around 12 range, where I would consider it on fire sale, but right now it's trading at a discount to its 5-year valuation and a discount to the market. I think for me, I'm going to be adding to my position in American Express, which I only started recently. For some time, going to be dollar cost averaging until its valuation gets too excessive for my liking. However, I think this is an excellent business, so I have no problem holding this over the long term, just as Warren Buffett has. Of course, that's just my opinion. You should do your own research and due diligence on the stocks that you buy. Don't just do it because I'm telling you, or you should see a registered financial advisor. Like and subscribe if you enjoyed the video. Comment down below what you think of American Express, what you think of some great compounders in this industry. You might like Visa card, you might like Mastercard more. Let me know what you think in the comments down below. I'll see you again next time.